Hello friends, this is Martin from Secret, the channel for learning about trading and investing. Welcome to Markets Next Week, the weekly stock market analysis show. We will look at technical charts and then try to understand what happened in the markets during the previous week, and then also plan for a better trading week that's starting from tomorrow, Monday, June 16th, 2025. So let's keep looking at the charts. Here we have the Nifty charts of the weekly and the daily that you see there. And it's in the panel channel. It was in a recovery mode. In between, it formed a big red engulfing candle, bearish candle last week, and daily charts also shows it's clearly hit the top of a short-term chart trend line, and then had a nosedive gap down, breaching the 20 exponential moving average. In Banknifty, you see the narrowing ascending wedge also hit the top of that channel, and then looks like it's reversing. On the weekly of the daily of the Banknifty, you could very clearly see that big nosedive reversal candle that is closing below the 20 exponential moving average. So that's the story. So in a nutshell, this is what happened. Nifty closed nearly 300 points down, 1.15, and lost the 20 exponential moving average support. So actually it reversed. It was a hockey stick move last week on the Nifty with a breakout. Now it has turned out to be a breakdown. We all know why it has happened, following the poor global cues that came after the Middle East crisis of Israel-Iran war and all that. Banknifty is also reversed and broke down, right? And it was even more bigger cut of 2%, like 1,000 points gone, 1,086 and 1,051 points to be precise. And keep in mind, we had earlier had a correction of nearly 17.23 and had is on the way to recover that, while Banknifty had a very small correction of 12.5% only, and had recovered and made new all-time highs recently. So it was in a breakout mode when things all suddenly changed. Last week the breakout mode was set by the RBI's rate cut to 50 bps, and this week everything is seems to be suddenly turning bearish, and it could continue to be like that if the conflict continues. So unfortunately, the entire financial year of 2025 has every month had big setbacks and big recoveries. So it was very volatile 2025. April month we had the tariff threats that came in and market fall and recovered. Then the May month we had India-Pak conflict, then markets fall and then recovered. And the June month you have the Israel-Iran conflict, and market is falling and expect to fall furthermore. So that's the volatility that is seen in the markets, and traders will have a tough time, while investors could find opportunities in the long term. So candlestick wise, if you see, it is definitely a bearish candle on the weekly. Not fully engulfed, but it's almost engulfed the body. Means if you consider the wick also, it has engulfed the previous week's candle. So big bearish candle, even more bigger engulfing candle in the Banknifty. So short term, we see that inverted V shape with a Friday back gap down. Inverted V shape move reversal with the Friday back down. So reversal started in the Banknifty several days before, and Friday has a big gap down. But the market had intentions to move up further and break out. In fact, Banknifty had hit the all-time highs about 57,010. This nosedive was happening on Friday. So that was a kind of move, if you see. But candlestick-wise, it was green because good recovery happened on Banknifty and Nifty both on Friday. After the initial gap down, it recovered. Let's worry about that. And Bollinger Band is indicating it is sideways consolidation with a bearish bias on both. Right, just heading up, suddenly a short consolidation. We'll have to wait and get a confirmation whether it's breaking down or expanding down or up. As of now, sideways move means consolidation, and more sideways move will be expected looking at the Bollinger Band in the short term. That's the story. If you look at the momentum and the trend indicator, RSI is what we use for momentum. Weekly and daily charts are used on the left side, weekly, and right side daily of Nifty and Banknifty, both indices. And clearly the momentum has taken a hit, and it has taken a severe hit on the Nifty, but slipped to the sideways, but Banknifty is still holding on the bullishness. Overall, we can say moment was dipped on the surely on the short term on the right side, just as it indicates, but medium term it is holding on to that, although slipping sideways. So Nifty has already happened. So problem hit badly on the short term side, into the sideways in the both zones. On the both charts you can see on the right side, Nifty on the top, right now, daily on the Banknifty on the downside, and this is the short story. Now ADX is the trend indicator that's used, and that indicates that short term there is a crossover to the bear zones that has happened, but long term bullishness is main. So overall, moment when the trend has not confirmed to have hit badly on the medium term, but short term definitely it is not bearish and sideways. Now what happened in the India VIX is also interesting. You can clearly see a spike of 3.3% up, which means the fear has come in, but the fear has not come in as much as it was expected. It's just 3.3, despite all of this, and we'll have to keep a close watch as to if this spike is extending further or not. If this conflict is expanding and the VIX is spiking up above the 15 to 16, 17 levels, then we may have trouble. But as of now, because of the quick recovery that happened in the Friday itself following the gap down, the VIX is cooled off after an initial spike. But overall, VIX spike indicates that there is some fear that has come in, which is obvious. No open interest analysis on the options and the futures both are bearish. Short better we see in the futures, and for the June 19 weekly options showing huge resistance that's built up at 25,000 zone, and PCR is 0.7 on both, which is bearish. Nifty and the Banknifty both, but Banknifty is in a monthly while Nifty is in the weekly keep that in mind. So bearish indicators from the options and the futures Now these options or the call and the put writing can be used to find support and resistances, and that's details are provided here. Nifty, it seems like it's a slightly wider range of 24 to 25,000, while that's where the highest put and call writing is seen, and 24,500 and 25,200 is where the highest put and call writing, second highest put and call writing is seen. Well, Banknifty monthly is showing the same, 56,000 is where exactly the put and writing is happening, and then if that is breached, the 56,000 is lost. Still have four more days for the expiry. Not 4 more days, it's a monthly. So monthly nothing has changed much, although it is just a Friday move, so we'll have to wait for the next week to get the real picture. So as of now, things looks like it's between 55 and 57,000 point range. That's what is happening now. This is the technical charts that you see for the Nifty and Banknifty. Based on that, we can find the support and resistance. That's what is indicated. Have a close look at that. So basically, first resistance will be the 20 daily exponential moving average, which is the first thing, and this is coming at 24,800. 24,800. That's where the first hurdle is there. If that is clear, then Fibonacci 23 at 24,867 is where the second hurdle is. After that, it can be a breakout move from the channel top, and then 25,000 and 25,730 would be the resistances there. 39 actually. Outside support will come in at 50 exponential moving average, and then you have the Fibonacci 38. There's a gap that's coming. That's there, 100 exponential moving average, and then previous lows, swing highs from where the breakout happened, and 200 exponential moving average. That's how it goes. So levels are mentioned here. So it's 24,355, Fibonacci 38, previous swing highs, and 50 exponential moving average all comes in there. 24,355, 24,165. So 24,000 would be a very, very good support, even if something bad happens or the extension of this correction happens, right? Resistance similarly will be 25,000. Banknifty similarly 55,721, 20 daily exponential moving average is where the first resistance is there. Then there is 55, so 56,000 would be the major resistance. Right? Downside for support could be 54,000 major one. Right, 55 is just breached, then 54 will be major. In between you have a gap and the previous highs and 50 exponential moving average. That's it. So first hurdle will be to take back the 20 exponential moving average. Second will be the gap that appears at 56,000 nearby. So 56,000 will be a major hurdle. If that is clear, then it can get back to the all-time highs. First support will be 54,500. That sounds 54,500. If that is breached, then first 55,000 rounding number has been breached, then 54,000, then you have 54,500, means you have the 53,888 and all that. So the details levels are mentioned here. So look at this charts and then look back at these figures and then find your levels of support and resistance that you can look at. Now if you look at the sectorial indices, the major ones, you can see that last week the IT sector had moved up and pharma has also moved up. IT is 3% up, pharma is 1.5%. These are the defensive stocks. When on market crashes, this is what moves up opposite. So defensive stocks are there, but otherwise all the other sectors have fallen down. Metal 1.6%, auto 1.4%, FMCG is 2.5%, reality is 3% down more. So that was a big reversal that has happened across the sector, while IT and the pharma sustain. So as of now, if you look on multi-time analysis, none of this are ready for a long bet. Right? It's mainly sideways that's been maintained, you can see. So the sector indices charts is what you can see there. Right? That has done well, and the pharma here also has done well with the green candles. But others are also were sideways and trying to climb level zones, but in between we had a war. That's what you see in FMCG, that's what you see in reality, that's what you see. All ready for a breakout, from the price point and the momentum point. But there's a pause that happened because of the Friday's gap down. Now, heavyweight stocks are those stocks that contribute maximum to the indices. And HDFC Bank, look at that engulfing bearish candle, but there is a positive reverse divergence which can have the momentum supports taken here, and then a bounce up can happen. But if that fails and breaches and falls in the sideways, then we may have trouble. So a lot of this week's low on the HDFC would be very crucial. HDFC also was in the top of the trend line channel. See that. Reliance also managing the bullish momentum, just like the HDFC Bank. HDFC Bank also managing momentum in the bull zones, although hit badly. All three red candles, but momentum divergence could take it back to the place where it breaks out, or it is very crucial point. Right. So all the heavyweight stocks hit back, but those are the three big stocks that was holding the market. No idea had done well last week, as you can see there. This managed to hold on the sideways move. Black Bank is also managing to maintain that bull zones. It is a contrast stocks that always consolidate. And LTC is also maintaining the sideways but slightly falling down while it was trying to attempt to move up. But no, it didn't happen, and but it's maintaining the momentum sideways is maintained. Total markets have also got hit, but look at this, momentum is bullish on both small cap and mid cap. So we'll have to wait for the next week to see if this bearishness could further intensify or not. But as of now, things look okay, not bad. Although clear hit back on the momentum and trend and the price candlestick wise, it's suddenly turned red. Is very much evident, right? But yeah, that's about the price in the different sectoral indices and support resistance and all that. Let's move it. We would like to see how the institutional participation happens. So it's 1,240 crores of selling. Last week also it was a similar kind of small selling that happened. But look at domestic institutions, they continue to buy near to 25,000 crores. Last week also they managed to buy heavily. So the domestic institutions are heavily bullish, while FIs are not heavily bearish. They're selling, they're net sellers, but in between they buy. So they're not heavy sellers, at least. That's a relief. But they also have to come in for the market to break out to the next level, for the next level of Friday. Derivative signs, FIs and AOs, have placed bearish bets, looks like. Now, let's look at the global markets and currencies and comparatives and all that. Currencies, dollar index has fallen down 1%. Look at that. It's a very crucial consolidation zone. It is below the 100. It's 98 now. So momentum is bearish and falling. So dollar is falling. US dollar is falling. USD INR, the currency is spiked up 0.4%. UPS for the weekend is that's what it indicates. right? So the US dollar fall is not helping the rupee much, right? Continues to be weak, and crude oil is where the big thing happened. Spiked up and attempted to break out following the war news. Crude oil momentum is just climbed into the bull zones. Crossover of the trend has happened, and if it breaks out of this very long trend line, then we may have a trouble as an emerging market. Gold spiked up once again, heading towards the all-time high once again. It seems like it was consolidating, and there was now a lot of reports saying that gold is finally correcting after the big breakout. Now that the Trump's tariffs are cooled off, but yesterday when the war broke out, Middle East crisis came in, and the gold is once again shooting up. It moved up nearly 4% up, and momentum is bullish pricing. So it's good news as well as bad news. Good news for those who are using it as hedging instrument. Bad news is indication that the equity market money is moving into the commodity market gold, because equity markets are probably correcting even more. So that's a fear that may be indicative of that. That's how we have to look at it. So US markets, as expected, when the war conflict came, reversed and could not sustain the move in the sideways and rising up move. Now it is turned to momentum has turned to sideways and falling. So Dow Jones that you see on the left is having a red candle, wide range. Nasdaq also falling red, and S&P 500 also has a red candle, but it was sideways and falling, and it is 1.35% on. So 0.5% on S&P 500, 0.5% on Nasdaq, down 1.3% down on Dow Jones. So that's US market is red, is not good. So global gives are definitely bad with respect to crude oil, and with respect to US markets, with respect to the gold, and with respect to the dollar, with respect to the USD as well. Things are not that great. So global gives not good. Let's stop the analysis and have some actionables. Both of these 2 weeks, both these stocks are on the long side itself. TLF, real estate. RBI rate cut could continue to push the real estate stocks up. Now tight stop losses because of the conflict news and the market index falling down, but momentum is bullish, trend is bullish, good volumes, one is a RiskReward can come in. Pharma is a defensive stock, can place a bet because the flag breakout possibilities are have tight stop losses. If it breaks out, the target can be the height of that parallel channel. Momentum is bullish, volumes are good, trend is bullish. Landmark, pharmaceuticals, pharma stock, long. TLF, reality stock, long. Make a note that this is not recommendation. This is for education purpose only. You buy the stock or sell the stock as per your discretion, your risk profile, your risk appetite. Everything is your money. This is not recommendation for you to do anything. This is just educational. I'm repeating that. Same here as well. FNO strategy. This is the Batman strategy for the weekly Nifty options, and you can say very good range of 1,000 points you get, as long as the market is staying and not falling below the 23,500 and 25,500. If it is not breaking that on the upside, this is the best strategy with a reasonable risk reward and the profit. Remember, this is not completely hedged. Although there is inside hedges, it's Batman strategy is selling out for OTMs and selling inside hedge OTMs, buying inside hedge OTMs and selling outside OTMs for OTMs. One more hedge can be applied, but you will get no profit then. Batman can have one extra wings of call and put buying on one lot each on both sides. Could reduce the risk, but reduce the profit as well. But this is an unhedged Batman strategy they're saying, which could probably have very good range in this crisis. But if it breaks down with a heavy gap down 1,000 points plus, then exit immediately at the break-even point. Do not try to adjust because it may be too risky to do that. You may not be able to do that. You can try to buy in some puts in case such a thing happens. Half the quantity of the total quantity that you're selling, you can try to hedge. But it will be too risky. I would suggest you exit in case there is a big gap down that continues to happen in the next couple of days, right? That's the Batman FMO strategy. Again, this is not a recommendation. Now let's try to wrap it up. So market did a reversal after previous week's hawkish took more. Market reversed with nosedived with the inverted V-shaped move following the Iran-Iraq conflict. Not Iran-Iraq, Iran-Israel conflict. And market closed negative, obviously, losing the momentum and the trend. The trend is, and the momentum is sideways and bearish in the short term, although the medium term things are not that bad. because it was a Friday gap down that happened. So we'll have to wait for one more week for the candles to show the actual picture. FI has continued to be sellers for the last week as well. So always keep in mind it was 79% correction after a 70% rally. Same against the Banknifty as well. And Banknifty was very close to the all-time highs, 57,000 above before it nosedive. So it is at a crucial point of breakout or breakdown, and market decided to break down following the news flow. Now, if you try to bucket together an analysis for the next week, and if you try to put in different parameters in the buckets of bulls and bears, this time it's a bear that seems to be having more things in that bucket. And what is in favor of the bears? Let's look at first. The FIs ended up selling more. US markets are red. India is spiking up. Options OI, PCR is negative. Futures OI, short build-up is what you see. Crude oil is spiking up and breaking out of the trend line channel. Gold is breaking out. Momentum is dipping sideways. Short-term trend is turned bearish. Price below the 20 exponential moving average support. And Bollinger Bands a purish bias, although it's consolidating. So, what's in favor of the bulls? It's just the fact that the heavyweight stocks are still in the bull zones. The HDFCs and ICC banks, Reliance have maintaining the bullish momentum in the medium term, not broken down completely. Not to wait. And the broader markets are also in the bullish momentum. Not to wait for next week candle for that. And major sector indices are also maintaining the sideways momentum, right, along with the heavyweight stock. So that's all I hope that the bulls have. And looks like my view could be mild bearish for the next week, considering the kind of volatility that could come in case things go bad in the Middle East crisis. Technically, the charts wanted to break out, but it is a quick reversal at a crucial breakout zone, trend line channel top. So keep that in mind. The technical analysis is equal to 0, or could not work well as you expected it to be. Although the resistance support zones could be used for finding just the resistance support zones. But otherwise, it may turn horribly wrong if you rely completely on that. But black swan events like wars and big events happens, no? Just like India-Pak war. No, all analysis goes for a toss, except that you may have some clues on where the support resistances. That's all. So place your bets accordingly for the next week. View is might be so. Levels for the next week's 23,500 and 25,000 is what I look forward. 52,000 and 56,000 is what I look forward in the Banknifty. So keep that in mind. As long as you don't close more than 26,000 with the green candle above the 57,000, you're not in the next leg of rally. Until then, you're just trying to recover, breaking down, correcting, recover. That process is what is continuing, and not the next leg of rally until you've reached that figures. Now, keep one thing in mind. Risk management is what trading is all about. Always protect your capital. Keep your hedges for portfolio, hedges for the positions must. And using this hedging, using the options, you can also make some money in rental income by using some strategies like covered calls and cash out puts and reload strategies and all that. Check out the playlist for that. That's all I have. If you like the content, subscribe. If you like the content, hit the like button. You can put in your comments, feedback, and please share this video to others if you like it. And I'm also active in X with my daily technical analysis. You may subscribe to that as well. That's all I have for this week. Happy trading, happy investing. Bye bye.